Students are usually the social conscience of societies. And so it was when I graduated from university 30 years ago. My generation knew we were growing a social conscience. It was early days for it then, but it was happening. And we knew there was exploitation, we knew there was greed in the world. But we were hopeful, and we believed we could do better than our parents' generation with the world we were inheriting. 30 years, 3 decades. And so we've seen some remarkable trends since the early 1980s. According to some studies, the top 1% of the US population owns 40% of the national wealth, up from 33% at that time. A recent study, Thomas Piketty's book, which has been a huge bestseller in the States, he shows that the global Gini coefficient, after dropping the Gini coefficient to measure income disparity between the rich and the poor, was getting better from 1820 to about 1960, 1970. Since 1980, it's gotten worse. So we're back to 1820 levels in terms of income disparities in the world. Some studies say that the average chief executive officer's pay is now 150 times the average worker's pay, up from 50 times when I graduated from university. And as we've seen GDP growth, the red line on this chart, you can see that corporate profits have risen at an accelerating pace, while labor share of that income has actually not even kept pace with the GDP. I don't think this is what we envisioned when we graduated. This isn't what we hoped for. This isn't what we said we were going to do. And so there's unfairness in the world, and we can see it. And what's worse, it seems that the people perpetrating the unfairness, the greed, are actually still getting away with it. Sure, fine the bank $1 billion, makes no impact, right? Some of you may have heard the story of a hedge fund manager in the US last year who paid an admission of guilt fine of $1.2 billion and had his hedge fund shut down for systematically trading on inside information in the public capital markets, right? And so you're saying, great, $1.2 billion. As a result of that fine, his personal wealth dropped, taking him from being the 43rd richest American to being the 59th richest American. Didn't go to jail, of course. So is this justice? Is this what we expect? No, it's not what we expect. So we have this unfairness and injustice in the world, and we can start understanding why the 99% are getting a bit cheesed off. And it doesn't take a lot of imagination to see that the future is going to hold things like higher taxes, more regulation, which we're seeing already, and possibly a series of workers' revolutions in the world, taking us right back to the 1950s and 60s, or earlier. So it seems my generation has spent this 30 years of our careers being willingly co-opted. So well-intentioned we may have been, but we were willingly co-opted into a system that actually made us the bad guys. My industry, the financial services industry, gave us the global financial crisis and many of the sins we've seen and witnessed, the worst excesses of the greed and exploitation. In a study last year by the CFA Institute, only 52% of investors asked said they would trust their asset manager to do the right thing. Think about that. Who do you give your money to look after it, to invest it for you? Your asset manager. Only half of you trust your asset manager, or you hand him over your savings? This is an outrageous result, and yet it speaks volumes about what happened leading up to and after the global financial crisis. As an asset manager, I find this is a personal affront to me in my industry. So my message today is that it's not all bad. There are many good people in this industry, that the excesses of the few aren't representative of the all, that you can invest responsibly and profitably, right? You can align your investments with society's goals and outcomes. By the late 1990s, this evangelical church in Soweto, the Grace Bible Church, had been meeting under trees and in rented accommodation for many years, and they'd been saving money, and they were ready to build their dream church in Soweto. They had a piece of land, they had good ties, good bookkeeping, good leadership, steady congregation, and they had plans drawn, municipal approvals, and they went and they'd saved half the money they needed to build this church in Soweto. So they went to their bank where their money was being saved, by the way, and they said, look, just make us a loan for the other half of the money. What do you suppose the bank said? Right, you got no chance, right? Okay, so they went to all the banks and got the same answer. Nobody would lend money for a church with a good business plan, the foundation of any good investment, right? A good business plan, couldn't get the money. Somehow they found us, we looked at it, as we did some due diligence, we determined we could make this loan, and we did. We made a straight mortgage loan, and they built this building, which at the time was the biggest meeting hall in Soweto, holding up to 5,000 people. On commercial terms, mortgage bond, sureties from the founders and the leaders of the church. And they paid it back early, and they went on to build a phase two, the building behind the main building, which has classrooms, a gym, I think there's a computer lab in there so they can do adult education, and it's a great success. That was done with pension fund money. Good commercial investments, good social content, done with people's goodwill pension fund money. We started in the mid-1990s with a basic premise that infrastructure and developmental investments were economically productive both for the investors but also for the society. We had some data that showed that, and I'm not going to read you this whole slide, but I'll just try to pick out one thing. Take a look at the bottom. This says that of these many studies, and this is an old slide, that a 0.39% increase in the stock of infrastructure would increase, a 1% increase in the stock of infrastructure would increase GDP growth by 0.39%. $1 in, 39 cents back in the first year, and then 39 cents again, and so on and so on. GDP growth was perpetually higher, so you get huge returns on investments. Look at those numbers. Fantastic returns on investment for infrastructure investment. And just as recently as last month, I'm choosing this specifically as an old slide because just last month, the International Monetary Fund released quite a big and detailed report, which I'm going to horrendously paraphrase, if you forgive me. An increase in public investment of 1% of GDP boosted the GDP growth levels by 0.4% in the first year and 1.5% 4 years later. Same story. Infrastructure investing is productive for society, and it can earn good returns for investors. So, in the wake of South Africa's transition to democracy from the mid-1990s, we've had the pleasure of investing in a range of developmental investings, healthcare, roads, low-income affordable housing, rural development, water reticulation, electricity reticulation, and so on, including, when I'm getting to it later, alternative finance. And during that period, we've had a remarkably stable and growing and foresighted group of investors who let us use their money to do this, because it wasn't proven at the time. Nobody knew it was going to work as well as it did work. But we had these investors who understood that sustainability and profitability are two sides of the same coin. They can go hand in hand. And so we proceeded from that base. So that's half the story, doing good. But remember, our primary goal is to invest people's pension funds. Our primary mission is to earn the appropriate returns for the risks we're taking. It's a mission in itself. It's enough of a job in itself before we even get to doing good with the money. So the question is, are we doing that? Are we achieving that goal? We're doing good, but are we doing well? Our infrastructure bond fund recently won an award just last year for being the top performing bond fund in South Africa for the past 10 years. Of all the bond funds, not just development funds, of all the bond funds in the country. So indeed, strong developmental impact and good economic returns for the investors. And all of this stuff is clean and green. It makes us feel good in a variety of ways, whether it's housing or wind and solar or urban redevelopment and such. But judgment sometimes has to be exercised. It's not always clear-cut what is socially good and what is not. So in the first wave of black economic empowerment, the 1990s and 2000s, we saw quite a lot of proposals from black groups to buy into casinos, to buy into tobacco companies. Well, BE is good, redressing the imbalance of the past. Casinos? Really? Now, how do you debate that issue? Well, we did, and we determined we weren't going to make those investments. BE is good, but it doesn't offset the evil that comes from smoking and gambling. I'm sorry, you may not all agree with that. Well, tough. It's my presentation. So judgment must be exercised. There is no rule book. There's no set of laws that defines what is developmental. It's up to each investor to think about what they want, what funds they invest in, who they hire to manage their money. There shouldn't be any regulation about this because different people have different opinions. Some of you may smoke. I don't. So it goes. A more nuanced example is this. We were approached a few years ago by a large chicken processor who wanted to roll out a series of relatively small owner-managed farms to grow broilers as in broiler chickens, in various rural areas. So we looked at that deal, and it has all the elements of good socially responsible investing. It's rural development, job creation, often black ownership, food production at a time when food scarcity was a problem, small enterprise development, and so forth. But blink and look again, and well, this could be part of the factory farming of animals, couldn't it be? You know, in each 42-day growing cycle, 40,000 day-old chicks are put into one of those houses. They're fed on a regimen. They get light and water on a regimen, and they're coaxed to turn grain into protein so they can get nice and fat. They're pumped full of antibiotics. Then they're slaughtered, pumped full of saline, and sold to us for dinner. Good or bad? Do you want it in your portfolio? So it's axiomatic that if you're going to try and make good investments, roads, hospitals, and such, you must avoid bad investments, armaments, gambling. But there's a middle ground in many of these things. It's not always clear-cut. This is the area of engagement, where you might engage with the borrower or the investee about how they run their business. So in my chicken farm example, we asked about the use of antibiotics. The appropriate levels, was it destructive to the potential down the food chain? Was it absorbed into the animal, or did it go through to human consumption? And this sort of question. That's engagement. That's asking questions. And as a rule, you have to do that because you really have to, in today's world, engage with the world as it is towards the goal of the world as it should be. Things are rarely black and white. The Church of England has actually shown excellent thought leadership on this. And this is their Archbishop Welby, quoted a couple years ago. If you exclude any contact with anything that directly or indirectly gets you at any point anywhere bad, you can't do anything at all. And he's talking about their investments, right? He's talking about their investment policy statement. So can we go a step further? We've done the good, we've avoided the bad, we've engaged in the gray area, but what if something is clearly bad? Should we go further and actually publicly come out against it? Well, this takes us to the story of the microlending industry. And from the 1990s, microlending was a definite need. The big banks wouldn't service the unbanked communities, so the alternative finance sector was necessary. I mean, education, cars, small businesses, houses all require some sort of finance for people. So originally, microfinance was not a terrible thing. In fact, Muhammad Yunus won the Nobel Prize in 2001 for his work in microfinance in Bangladesh. And it became the darling of the international community. Jump forward 10 years, and there's microlenders on every corner. There's aggressive sales techniques being used by commissioned salespeople. There's SMSs, there's emails, there's placards. And debt is being pushed onto people who actually can't afford to pay it back. And we were attuned to this trend, although we were an early supporter of microlenders. We were starting to get attuned to the anecdotal evidence coming out that this was not all good and we were impoverishing people. Muhammad Yunus himself, having won the Nobel Prize, reflected on it about a decade later and had this to say: microcredit is supposed to support income-generating businesses aimed at uplifting the poor out of poverty. Microcredit was created to protect people from moneylenders, not to create more moneylenders. And so it goes. Come around 2011 and 12, we started getting a bit nervous and started reducing exposures in our funds. And by 2013, we publicly came out, it was just over a year ago now, we publicly came out and said we would no longer be funding microlenders in any of our developmental portfolios. And we made the implicit statement that we were actually cutting back funding in all of our portfolios, which we were doing. We had to be quite careful because you can bring banks down that way. Let's not go there. Okay. Point is, it's important to understand that what was happening was visible to all of us. It was visible to us as asset managers. And in so doing, while the failure of African Bank is a tragedy for the job losses, but the fact is it was foreseeable. It turns out that impoverishing your customer is not a sustainable business strategy. I know, rocket science, right? Okay. And by the way, Regulation 28 of the Pension Fund Act, just amended about 3 years ago, had this to say about incorporating sustainability factors, ESG factors, into your investment process. That any prudent investment strategy must give consideration to all the factors that might affect an investment, not just financial, but how they govern themselves, what their impact on society is. So this is a ringing endorsement for Regulation 28 for ESG factors. African Bank proves the point. Analysis showed it was foreseeable. Now, that's not to say that all microlending or alternative lending is bad. Even today in our funds, we're funding taxi drivers to buy their own vehicles. Everyone is small enterprise, everyone is small business. We're funding people to buy low-income affordable houses in a variety of ways, both rental stock and to actually buy and own houses. We're funding people, both universities or education institutions, as well as individuals, to get financing for their education. So alternative finance is not implicitly bad. It's important the money be used for the right thing and not the wrong thing. So my message is you can invest both profitably and responsibly. That you can align your morals, your humanity with your investments. And a couple of pointers. If you're a member of a pension fund, well, you should talk to your pension fund trustees. They work for you. Ask them, what are you doing about responsible investing? What's your sustainable investing strategy, Mr. Pension Fund Trustee? It's your money. Or if you're looking for a unit trust investment, are you asking the unit trust management companies what products they have that actually speak to your social conscience? If you don't ask, they're not going to offer it. Think about my chicken analogy. If we all go into the shop and ask for free-range chicken, don't you suppose there's going to be a demand response to that supply? Of course there will be. Same with investments. But in South Africa, what we find, unlike the US and Europe, where people kind of think global but act local, we don't see that here. I can count on two hands the number of retail investors who have asked me about responsible investing in the last 10 years, which worries me. So my injunction is this, in conclusion. My injunction is this. What happened to the financial services industry? The casino banksters, the financial product pushers, the rapacious micro-lenders, the asset managers more worried about their fees and about their client outcomes, could not have happened if people were paying attention to how their money was being invested and managed. My injunction then to you is to own your money, to engage with how your money is invested, and don't abdicate that responsibility. Thank you.